Okay, Assalamualaikum. We are going to see again me, your lecturer Dr. Lizz, with another topic on variance analysis, which is a sales variance. So this is the last part of the variance analysis that we are going to look at. Okay, so far we have looked at the spending variance, which are the costs incurred for you to produce a product. We have compared the standard cost with the actual cost. Okay, so we look at direct material variance, direct labor variance, then variable overhead variance, and then fixed overhead variance. So those are what we call the spending variance. Now we are going to look at the revenue variance, which consists of the sales variance. So this is your income, the sales, the revenue that keeps coming into your business. So we also want to investigate whether there is a variance in your budgeted sales and actual sales. Okay, so as you can see here, for your sales variance, we will have two types of variance. Number one is what you call sales margin price variance. Okay, so we are talking about price variance here. Sales margin price variance. So what we want to look at is the difference in actual margin and also the standard margin. And we are going to multiply it with the actual volume, that is actual units sold. Okay, another variance under sales variance that we will look at is actually the sales margin volume variance. Okay, sales margin volume variance. We are going to compare the actual volume or the actual units sold as compared to the budgeted volume or the budgeted units sold times with the standard margin. Okay, so these are the two variants that you will need to look at under sales variance. So it is quite short, it is quite simple. Still, we are going to compare based on the price and based on the quantity. First, we look at sales margin price variance. How are we going to solve the sales margin price variance? Okay, using the same example that we have done in our previous video series on variance analysis. So we are going to look at this question. It says that the question asks you to calculate the sales margin price variance. So we are going to compare the price, the actual price and the standard price. But here we say sales margin price variance, not the sales price variance. So what is the difference between sales margin price and sales price? So as you can see, for you to get the actual margin, what you need to do is you need to use one formula. Okay, so to get the sales margin, actual margin, the formula that we will use is the actual selling price. You are going to minus it with the standard cost. Okay, so you will get your actual margin. So in our example here, what we have is our actual selling price is given to you here in this question, 11 ringgit and 11 ringgit. So this is how we calculate your actual margin, actual selling price, which is 11 ringgit. And then minus with standard cost. We always minus with our standard cost. And this is your standard cost right here. Your standard cost you have already calculated in your standard cost card. Standard cost is 5 ringgit. So now we are going to use that 5 ringgit here. You bring it here. That one will give you the actual margin. And then minus with the standard margin. Standard margin is the one that you already have in your standard cost card. This is your standard margin. Okay, it is also 5 ringgit. which comes from standard selling price minus with the standard cost per unit. So you get the standard margin here. Okay, so you can see that our standard margin is also 5 ringgit. So that's it, standard margin 5 ringgit times it with the actual volume that you sell. So here in your question, you already see that 8,000 units of plastic dustpan were produced and sold. So this is the actual volume. So we are going to use this amount times it with 8,000. Okay, so when you solve this, you are going to get the actual margin here of about 6 ringgit minus with standard margin of about 5 times it with 8,000. So you will get the answer of 8,000 ringgit. So you will get here the answer is 8,000 ringgit. Okay, so what does 8,000 ringgit mean? Is it favorable or is it unfavorable? Okay, so let's compare. Our actual margin is 6 ringgit. Our standard margin is 5 ringgit. So you can see that normally in the market, your competitors will get 5 ringgit margin. But on the other hand, you could make 6 ringgit margin. So of course, that is something better, right? That is better for you. So because your margin is high, then say that maybe you are better at selling your product has the price has increased, but people still want to buy it. So it's a good indicator for a business. Therefore 8,000 here has become a favorable variance. Okay, so that's it. Standard margin price variance. We are going to compare the actual margin and the standard margin times with the actual volume sold. Okay, so now we want to look at sales margin volume variance. Just now we were talking about price. Now we want to talk about volume. That is the quantity. Okay, the quantity that you have actually sold as compared to the quantity that you have budgeted that you can sell. Okay, times with the standard margin. So let's try to calculate the sales margin volume variance based on our question here. All right. So now it says that in order for you to calculate the sales margin volume variance, we will take the actual volume. So just now you can see that our actual volume is 8,000 units, just like the one that we have done. So 8,000 units minus with budgeted volume. In our case, the budgeted volume here is actually 6,000 units here. So this is your budgeted volume. So we will have minus with 6,000 and then times it with the standard margin. The standard margin, just like the one that we have already done for the price variance, this is your standard margin, which is 5 ringgit. So now your standard margin is 5 ringgit. Okay, when you solve for this, then you are going to get your answer is actually 10,000 ringgit. Okay, so when we look at it closely, we want to see that what kind of variance is this. So this is actually the actual volume that you have sold 8,000, but you have budgeted to sell only 6,000, but you managed to sell 8,000. Okay, so it means that you have sold more than what you have budgeted. So this is of course good news for you. You can sell extra 2,000 units. And because of that, we are going to say that the 10,000 there is actually the favorable variance. So to sum up what we have done in this video, you can see that we are actually trying to calculate the sales variance. So sales variance consists of two things, which is the standard margin price variance dealing with the price, and also the standard margin volume variance, which deals with the volume. Okay, so for standard margin price, the formula is actual margin, which can be calculated using this formula. Actual selling price minus standard cost minus with the standard margin, the one that you have calculated in your standard cost card, times it with the actual volume. So you have here 8,000 favorable variance. And as for the volume variance, so we look at the quantity of the units sold as compared to the actual units sold as compared to the budgeted units sold times with standard variance. So you can see that you have about a 10,000 favorable variance. So from this case, you are going to see that actually the business have an 18,000 favorable sales variance. Means that the company is doing better than the standard in terms of its sales. That is about 18,000, of which 18,000 actually comes from 10,000 from the volume variance, because they can sell more than what has been budgeted, and also 8,000 from the price variance, because they can sell at a higher margin as compared to the standard. Okay, so for sales margin variance, then that's all for today. So we will see you again for another video on another topic. Until then, stay tuned and study smart.